Welcome back to the channel. If you've been keeping an eye on dividend growth ETFs recently, you're going to want to hear this. After a couple of years that were relatively quiet for some investors, there's been a remarkable shift in the world of Schwab Dividend Growth ETF, better known as SCHD. In 2026, this fund is not just moving, it's surging, outperforming many of its closest peers, and even leaving a lot of broader market indexes in the dust. Today, we're going to break down exactly what's driving this rise, why it's happening now, and what it could mean for shareholders who are invested or thinking of investing in SCHD. We'll also explore the trends within the sectors that make up the fund, from energy to consumer staples to healthcare, and explain how these moves compare to similar ETFs in the space. By the end of this video, you'll have a clear picture of why SCHD is getting so much attention and why investors are optimistic about its prospects for the year. This video is for informational purposes only and is not financial advice. Always do your own research or consult a professional before making any investment decisions. Let's start with the numbers because they tell a story that's hard to ignore. As of early February 2026, SCHD's share price has risen more than 9%. That's just in the first month of the year. To put this into perspective, many ETFs might struggle to deliver this level of growth in an entire year, yet SCHD has achieved it in mere weeks. Compare this with the S&P 500, which is only up just under 2% over the same time frame, and you can immediately see the outperformance. If we widen the lens and look at SCHD's competitors, the contrast becomes even more striking. Take Vanguard's VIG, which is arguably SCHD's closest peer in the dividend growth ETF space. VIG hasn't been able to keep pace so far this year. Even Vanguard's high-yield dividend ETF, VYM, which targets a different strategy emphasizing higher current income, still lags behind SCHD's rapid ascent. DGRO, iShares Dividend Growth ETF, is also trailing, while the State Street Dividend ETF, SDY, comes closest, but even it doesn't fully match SCHD's early year momentum. The takeaway? Dividend growth ETFs across the board are outperforming the broader market so far in 2026, but SCHD is leading the pack. The question on everyone's mind, what's fueling this sudden acceleration? To answer that, we need to understand how SCHD is constructed. This fund focuses on selecting high-quality dividend growth stocks using 4 key metrics: cash flow relative to total debt, return on equity, dividend yield, and 5-year dividend growth rate. This strategy is designed to capture companies with strong fundamentals and consistent dividend growth potential. A key factor that explains SCHD's performance in the past is its exposure to energy stocks. During the reconstitution of SCHD in early 2025, energy stocks made up a significant portion of the portfolio. In fact, today roughly 20% of SCHD consists of energy companies. This is notably higher than what you'll find in ETFs like VIG or DGRO. While energy stocks are excellent for dividend income, they are inherently cyclical, meaning they can struggle during periods of low demand or oversupply. 2025 was not a strong year for many of these energy companies, which contributed to SCHD underperforming its peers at the time. However, toward the end of the year, this trend began to reverse, setting the stage for the dramatic gains we're seeing in 2026. Energy is a big driver of SCHD's gains this year, so let's dig into the sector. SCHD's energy holdings primarily include oil-related companies, those involved in drilling, equipment, servicing, exploration, and refining. These businesses can generate strong dividends, but they're highly sensitive to market events, supply-demand imbalances, and geopolitical developments. One of the most notable catalysts in early 2026 was the capture of Venezuelan President Nicolas Maduro on January 3rd. With Maduro now in U.S. custody, there's a renewed opportunity for U.S. energy companies, including major SCHD holdings like Chevron and ConocoPhillips, to expand operations in Venezuela. This country sits on the largest oil reserves globally, so the potential for new infrastructure projects and increased production is substantial. Investors have reacted positively, betting on the growth potential rather than worrying about immediate fluctuations in oil prices. This optimism has pushed energy stocks upward, contributing significantly to SCHD's early year performance. Another factor supporting energy's rise is extreme winter weather in the United States. In late January, a historic cold snap impacted dozens of states, caused thousands of flight cancellations, and dramatically increased energy demand. While this spike is a one-off event, It highlights how seasonal or short-term events can create bursts of profit for energy companies. Next up is consumer staples, which make up roughly 18 to 19% of SCHD's holdings. This sector includes household names like Coca-Cola and Johnson & Johnson. While not as volatile as energy, these stocks tend to move slower but provide consistent dividends over time. Consumer staples lagged in 2025, partly due to market fascination with AI and tech-driven growth. However, when investor sentiment shifts toward caution or a defensive posture, especially when inflation eases or confidence wanes, these companies often rebound. January 2026 marked one of the strongest months for consumer staples in over a decade, with investors flocking to the sector for stability and reliable income. Healthcare is another significant component of SCHD, though it hasn't experienced as dramatic a spike as energy or consumer staples. The sector includes established, dividend-paying companies that provide a steady backbone for the ETF. While healthcare performance has been solid, it hasn't driven headlines in the same way as the other two sectors. Beyond sector-specific movements, there's a broader trend at play. Dividend growth ETFs are seeing a resurgence because investors are increasingly valuing reliable income and resilient companies. After years of chasing high-flying tech stocks, many market participants are shifting to assets that provide stability, predictable cash flows, and dividends that grow over time. SCHD stands out in this context because it not only delivers strong dividend yields but also offers some of the fastest dividend growth compared to its peers. This combination of yield plus growth makes it especially attractive in a market that's balancing optimism with caution. Even when comparing SCHD to its peers, the advantages become clear. While VIG and DGRO provide solid exposure to dividend growth stocks, they tend to have less concentration in high-yield sectors like energy. SDY offers competitive performance, but doesn't quite match SCHD's rapid early-year gains. And VYM, while high yield, focuses more on current income than long-term growth. For investors deciding between these funds, SCHD currently offers a blend of high yield, fast dividend growth, and exposure to sectors poised for strong performance. This combination has helped it catch up to, and in some cases, surpass other major dividend growth ETFs in 2026. Looking forward, SCHD appears well-positioned. Energy companies have long-term opportunities in Venezuela and other markets, while consumer staples remain a defensive cornerstone for the fund. Even if markets experience volatility, SCHD's focus on strong fundamentals and dividend growth provides a buffer against sudden downturns. Of course, investing always comes with risks. Energy stocks remain cyclical and consumer sentiment can shift. But for long-term investors, the combination of yield, growth, and diversified exposure makes SCHD a compelling option. So, what does all this mean for investors? SCHD is off to a strong start in 2026, fueled by gains in energy and consumer staples. It's outperforming the broader S&P 500 and most of its dividend growth ETF peers. The fund's strategy of focusing on high-quality, dividend-growing companies is proving effective, and shareholders have plenty of reasons to feel optimistic. Whether you're already invested in SCHD or considering adding it to your portfolio, it's clear that dividend growth ETFs are attracting renewed interest this year. And while no investment is without risk, SCHD's combination of yield, growth, and strategic sector allocation makes it one of the standout options for those seeking income and stability in 2026. Thanks for watching. If you found this helpful, don't forget to like, subscribe, and hit the bell so you don't miss any updates. See you in the next video.